Hello again, welcome back. Thanks for tuning in this week. So I just want to start off with a quick story from showing homes last week, actually. And I'm showing these clients a bunch of places in Hamilton. Like we saw, 30 places probably over the last few weeks, but I'm showing a group of about 8 properties last week. And a few of them, maybe 2 or 3 out of the 8 were waiting on offers till a certain date. And we saw this one, and they really liked it. And of course, it was underpriced. And the offer day was actually that day. It was at like 5 or 6 o'clock. So these guys said, yeah, we want to put an offer. And so I'm getting updates. So as an agent, you'll get updates once you book a showing. You'll get an updates, 2 offers, 3 offers. So it ends up about 6 offers. My guys are like, yeah, forget it. We're not going to put an offer. Like, we're not going to compete with that many people. We're willing to pay this much based on market price, maybe a little bit less than the last sale, but they're not willing to overpay for this house. So anyway, it ends up there's 14 offers on this house, right? Which is ridiculous. And then now there's 14 offers, not because the market is hot. There's 14 offers because this place is listed $200,000 under what it should be. So I did my research, obviously, before for the people to kind of give them like a heads up of where that price would be. And it should have been between $835 and $875 for the last 3 sales on the street. Very similar, actually, almost exact same houses. And this place was listed at $650. So $185,000 under the last lowest sale and over $200,000 under the highest sale in the last year. Now that's 25% approximately, just under 25% lower than its true value or its market value at this time. So again, when you hear like there was multiple offers and there's 50 showings and all these kind of things, well, it's because they've been listed so low, it's ridiculous. Now, I'm waiting to hear what this place sold for because out of those 14 offers, they did choose one. And again, we did not submit on it. But it was conditional. So it wasn't like an unconditional offer where it was a firm deal the next day and they got their deposit. No, it was based on financing. So we will see now from 835 to 875 was the range, the current range for these homes. And we're going to see where that falls. Is it at the lower end? Is it at 875? Is it making a new record? Is it making a new low? That's how you really judge how the market is, not from a strategy of listing low and getting all these showings and offers and wasting a bunch of people's times because it's so low. Okay, so there's been a big flip in the script over the last few weeks, a month, depending on where you are and who you listen to, it could vary. But we've seen this year that, not everyone's bullish anymore. A lot of people are bearish now, and a lot of the big players are turning bearish. I was at a meeting there a couple of weeks ago in Toronto, and I happened to find myself in a room with some market research analysts, some commercial lending guys, and a commercial realtor. And at the beginning of that meeting, a couple of them were having a conversation with each other, public, right out in the public so we could all hear. And they were saying, well, this person's, they're bearish. And they're like, oh, yeah, I talked to that person. They are bearish. And then they brought up another name. They said, yeah, they've turned bearish too. And the other person said, no, not that person. They said, yeah, I was talking to them last week. So anyway, I don't know who these people were, but it just goes to show you that people are talking and the word is getting out there that the market is not so hot. And again, people are flipping to the bearish side of things. They're realizing that there's trouble in the markets. A lot of people are blaming tariffs and whatnot. I watched the debate last night for the Liberal leadership debate. I could only watch so much of it. It was kind of, sickening watching it. Sorry to be so blunt. But they were just tariffs. Like, it was just tariffs and Trump. Like, the whole debate was about Trump. It was not about like leading the country to the best fit and about all these other issues. They're just, blaming Trump for everything and blaming tariffs. And so we're going to see a lot of this blame. And I think I said it in my last video that everyone's going to be blaming these tariffs, and the tariffs haven't even started yet. They're going to come most likely, but they haven't even started, and they're already blaming them for everything. So again, this is a cop-out, but it's not unexpected. As I always say, the market is turning that way, and it's just based on that cycle of the rates and everything else. But even the Bank of Canada now has issued dire warnings and is very somber in this last report. You can probably see this video, or you might have seen it already, but if not, check this out. It's only 1 minute and 42 seconds long. And here from Bitcoin News says, Bank of Canada Governor Tiff Macklem warns of severe economic hardship ahead. Tariffs will push the economy onto a permanently lower path, and this time there will be no COVID-like response. So let's hear what Tiff has to say here about this.
In the case of a trade war, there's no bounce back. The if you introduce tariffs, the economy works less efficiently. We don't get those economies of scale. Businesses can't grow their businesses by growing their exports to the United States. So they're going to invest less. There's going to be less production. Incomes will be lower in Canada. And unless we introduce a new structural shock, some structural reform that boosts our potential output, but boosts supply, there's no bounce back. So what that means, for monetary policy, we can't change that reality. The economy is going to a permanently lower path. So the only thing we can do is we can help smooth the painful economic adjustment to tariffs. But even there, monetary policy is constrained because we have to make sure that the tariff problem doesn't become an inflation problem. So what that means is you're not looking like a COVID type response. We're going to have to proceed quite carefully. We're going to have to balance yes, there will be downward pressures on inflation from the weakness in the economy, but there's going to be also upward pressures from higher import costs, a weaker Canadian dollar, inevitable supply chain disruptions. That'll all increase cost, and that'll put upward pressure on inflation. So we're not. I mean, what I was really trying to convey in my remarks today is we're not thinking of a COVID type response here.
So yeah, there you have it. Not too optimistic there from the governor of the Bank of Canada, and he really seems like we're stuck between a rock and a hard place. Now they're blaming the tariffs, but this is what was going to come. Anything could have caused this situation, or what the situation is going to be, or maybe we're already in it. Who knows? But this is just what was going to happen with the reckless spending, the debt levels that we've taken on, and it's inevitable that we're in this position. And of course, now they get to blame something. They don't always have something to blame, but right now the tariffs is the easiest one. Now, talking about debt or household debt in general, look at this here. Household debt, a share of GDP. This is from World of Statistics. I don't know where they get their data, so I don't know the source of this, so take this with a grain of salt. But again, I don't believe that it's too far off. Canada, 103%, then UK and the United States, France, and so far down the line. So, yeah, of course, we all know Canada has a lot more debt per GDP and a lot more household debt than the U.S. did in 2008 or in the run-up to 2008. We've kind of taken that number one spot, and that's no mystery to anybody at this point. Now check out this Facebook post here. This is a Facebook marketplace. Someone sent me a screenshot of this, one of my clients actually. And this was posted on Facebook. Desperate sale, 4-minute drive from Niagara Falls, $6,000 monthly income, an 8-bed multiplex, 4 units. So yeah, I said, at least the sellers aren't desperate yet. Oh wait, maybe some are. Now this seller supposedly desperate to sell the house. I don't know who posted this ad, if this was the actual seller or the realtor. But this is what they said, like desperate sale. That's pretty desperate to put that. Now, I did receive a direct message or a private message when I posted this, and I forget if it was from an agent or just another buyer out there, but they said that they had offered on this house, and these people want a lot more than $575. Like, they're not willing to accept this price, supposedly, right? So again, I can't post the address. I'm just telling you what I heard, and this is just through the grapevine. So, but anyway, looks like they're desperate, and we're starting to see more and more of that. And from John Ravenda, this was an interesting post he made. I started building homes in 1986. Thought this was the best till Feb of 1990 hit. The tap shut off within a few months. Everything just died. Should have declared bankruptcy. Stuck it out with my credit line. It was ugly and I was about to capitulate. Then 1999 and some people actually wanted a starter home after 10 very long dry years. Stopped building a few years ago because of the level of debt out there. Back to that debt, right? We're seeing that debt levels. And it's true that debt's going to kill us. This correction is larger, more encompassing, and on a much greater scale compared to anything I have ever experienced. The correction will also be on another level and duration. Buckle up and get as liquid as you can, as it is all I can tell you. So wow, this guy's saying get your cash, and that's an interesting piece of advice. This guy seems like he's been around for a while. He's been building back in the 80s and stuff, so he's seen it all. Once you've seen the late 80s and the early 90s, that's about pretty much all you could have seen in Canada, and that was the worst of what we've seen so far. And I think it was, I just read Warren Buffett, like he's like almost 50% cash right now. So he's very liquid. So a lot of these people, again, this is not, I'm not saying everyone's liquid, but a lot of people are taking their cash and waiting because cash is only losing what, 1.9% a year right now. So it's been better than ever due to the lower inflation numbers. And the next one's from Brent Richardson. He's a mortgage broker, I believe in Ontario. I could be wrong, but he's a mortgage broker. I'm getting daily calls for rental property mortgage renewals. These are 2% fixed rate / payments, just breaking even on rents. One option is to extend the amortization, but usually they want to sell. It's not just the mortgage renewal cliff approaching, it's the rental property sale cliff. So yeah, that's true. Like these, why would you want to hold on to a cash flow negative property or just a problem asset? Like just get rid of it. You still have to maintain this thing. You have to worry about renewals, extended amortizations. They are just a hassle for many people if you didn't buy them at the right time. So just a few interesting charts before I get into my charts for the day. This is from Red Pill Rick here. This is a Canada 5-year, and he makes a good point here. If you look back to 2020 and you look at now, right? So 2020, what was the 5-year bond, which dictates the fixed rates in Canada? It was what, 0.5% or so? Now it's 2.7, and this is when all of these people are renewing here. You can see he says these people are renewing their mortgages this year. Yeah, so those people that in that blue circle, they're all going to be renewing now and a lot higher mortgage rates. Even though they've come down, they're a lot higher than they used to be. Really interesting one here from Steve Sereski on the downtown Vancouver condo price per square foot. Adjusted for inflation, downtown Vancouver condos have fallen 31% since peaking in 2018. And here it is. Yeah, so nominal price per square foot and from real price per square foot adjusted for inflation. So either way, they've dropped since 2018 per square foot, which is pretty surprising. I'm not very familiar with the rental market or the condo market in Vancouver, but yeah, they're dropping. And I didn't realize. I thought they peaked everything like last year or something, but that was the average price of all units. So yeah, the condos in Vancouver are not doing so well, just like in Toronto. This one's pretty interesting here from Scott Ingram, a realtor. GTA-wide sales this year suck, like really suck, he's saying there. Only 4 days of sales to go in Feb, and it's going to be the lowest by a good chunk in the last 10 years after the second worst January. So there it is on the left side there. You can see, yeah, look at the February, and he has all the Februarys lined up there, different colors. And yeah, I pointed this out to last week, and I think the week before. We've known this now. February is the worst by far than any other February. So not a good start to the year. I know it's pretty snowy, but yeah, we'll see how the rest of the spring plays out now. It's coming in quick. And from my man Chazzy here, he actually read through this article and summarized it, I think, here. Ontario's mortgage crisis is here. Delinquencies up 50%, 11,000 homeowners already drowning. And this is in Ontario. I'll get to the article there in a second. This isn't a warning. It's happening now. 11,000 plus Ontario mortgages missed at least one payment in Q4 2024, nearly 3 times the number in 2022. Mortgage delinquencies up 50% versus pre-pandemic levels. 90-day mortgage delinquency rate in Ontario up 90% year over year, far worse in Quebec, up 41%, and BC up 37%. 1 million plus mortgage renewals in 2025 could trigger a wave of forced sales. Toronto now has the third highest non-mortgage delinquency rate in Canada, 2.06, trailing only Fort McMurray and Edmonton. Consumer debt hits 2.56 trillion, fueled by rising car loan defaults. Wow. And then we have it. This is the article that he's quoting here. Ontario mortgage delinquency rate jumps 50% amid growing signs of high rate renewal shock. I'll have some mortgage delinquency stats or bank sale stats in a second also. And lastly, on my X News update here, B&Es, break and enters, are so common in Hamilton now that people are putting gates around their whole home. Wow, check this out here. Let's see what this guy has to say.
This is my house. So people were complaining to me why I have the gates. Well, with all those B&Es and break-ins in Brantford, or Brampton, well, now you know why I got the gates. Trying to come to my house. I make you guys into Swiss cheese.
Gotta love Hamilton. That's Hamilton for you. It doesn't surprise me in Hamilton. That's like downtown Hamilton for sure. So yeah, like they're putting gates around their whole house. I don't know if they've had problems in this area too. He's talking about Brampton, but he's in Hamilton. But yeah, it doesn't surprise me. I've heard a lot of break-in stories in rural Niagara Falls. Actually, we just got a thing, the cops released a thing like they're breaking into cars in rural Niagara areas now. I guess it's less risky, maybe. There's less neighbors to catch them. But yeah, lots of break and enters, lots of petty crime out there. All right, now let's look at some of my charts for this week. I just have a few to go through here. So this is an updated bank/power of sales from the Toronto Real Estate Board. The purple there is when we amalgamated our board with the Niagara board and some other boards. So anyway, I made a note there. But of course, they are higher regardless than last February. If you look at last February there in the middle, it was about 191. Now we have 554. But again, there is some combined data in there. But still, it's more than double what it was at this time last year. And you see here it's leveled off since since November, December, January, February. They've kind of been holding steady up and down month to month, but that is normal because if you look here, this was the first bigger green box there is December to March last year. 2023 into 2024, so last season at the same time, I should say. And yeah, you can see they're pretty flat, and they start to pick up Q3 or Q2 into Q3, depending on the year, but they pick up later in the year because in the spring we do have, or in the early in the year, I should say, we do have less inventory, more buyers, so the active listings are getting consumed or getting eaten up by the buyers. And then as the inventory builds, the power of sales will build. So you'll probably see maybe March might be similar, and then you're going to start to see in Q2 them start to increase, and we're most likely going to be a lot higher near the end of the year, probably double what they are now. We're going to see that increase, and I have circled, or I have put another box at the beginning of the chart there, but my data didn't go back far enough for that one. And yeah, just likewise, that's when it here in the red boxes, that's when they do increase. So the first red box, the smaller one, from August to November, they consistently increased. Same with last year in 2024, the big red box there from April all the way up to December, they increased. So we're seeing bigger increases for more months now in these bank sales. So yeah, we'll obviously continue to watch this, but they are staying consistently high at this point. This chart, I've updated it. I had released this chart last year, but I just updated it with the 2024 data since it's now available. And this is comparing who benefited the most. And this is how, just kind of shows how one way the government's they benefit more off inflation than you would. And of course, the asset holders. And you could almost break this down. The yellow would be the normal working class, the blue would be the asset holders, and the red is the government, right? So the yellow there is the median household income. And I use median. I wish I could use average, but Canadian data sucks. And they don't want it easily and readily available, this data. So some years they have median, some years they have average. But anyway, I managed to get median back to 2005, which is as far back as our CREA data goes with the household prices, right? So yeah, there it is, yellow. Of course, your wages went up 82% since 2005, and then blue is the asset holders, the average house price. It went up 177%, so pretty good returns there. But look at the government. The government, and this is Ontario, mind you, but we have probably one of the highest land transfer taxes in Canada, but we also have, 50% of the population or so in Canada. And look at the land transfer tax. 364% the governments, the local the provincial governments making on this land transfer tax. Toronto's making equal that amount because they have a municipal land transfer tax too. So yeah, the governments increased their revenues 364%. Asset holders, 177% are real estate asset holders, and you, the working person there, you're getting paid 82% more. So yeah, that's a big difference, and really puts things into perspective. Next, I would like to present this award to Justin Trudeau, and you can see a certificate of award. This is from me. This is one of my awards, and the most unaffordable housing. This certificate is proudly presented to the Right Honorable Justin Trudeau before he leaves office. Obviously, I want to give him an award, and I might actually hand deliver this to him. I might take a trip to Ottawa in a couple weeks. Maybe we're seeing, and if I do, I'm going to hand deliver this to the PMO's office, even though he won't be the Prime Minister anymore, but I'm still going to go there and deliver this. Probably actually later in March. I shouldn't say a couple weeks, probably 3-4 weeks from now. And yeah, there it is. In recognition of your time and dedication towards creating the most unaffordable housing in Canadian history. Now, in real estate, if you know the rules, we can't hand out awards without backing it up with some sort of data or justification. I can't just say I'm the best realtor in Canada. I have to prove it somehow. So I do have my stats, which I will attach with this award when I deliver it to him. And here they are. Move my head out of the way here again. So yeah, so here is the Canada house price to income ratio. So how much are you making, and how much is the average house? And yeah, so back here, sorry, move my head there. In 2005, which is as far back, the historical data that I have from the Canadian Real Estate Association. Back then, look at our wages in the red line there. Barely went up at all for the median household after tax income, mind you. You got to take the after tax. Banks, they approve you, and mortgage brokers, they approve you on pre-tax. They say, oh, you made $120,000. Okay, we're going to put that down. Well, that's not how much you make. You're taxed, right? You get taxed. But so this is actually how much you take home here. And look at the house prices in the blue. Of course, they've gone up, and your income has barely gone up. But everybody knows this. This isn't news to you. And then I have the price to household income ratio. And now I will say it's not fair. I should be using average house price to average household income, but you can't get the average household income consistently in Canada. So I had to go with the median. So you can knock off, maybe 2 times. So you can drop this by 2 each one maybe, or something. I'll tell you what I mean. Here's the blue line, the blue dotted line in the middle of the sheet here, the vertical line. That and before then was when it was considered affordable. So that would have been just over 6, which would have been about 4 to 4.5 times your income if you're comparing average to average instead of average to median. But yeah, it's about before then it was affordable, and everyone knows before 2012 it was kind of affordable to buy a house, and the economy wasn't the greatest, but house prices were still okay. But then after 2012, 2013, things really started to take off, and of course 2015 they really took off, and the rest of that story. They just went to the moon after that. But you can see it is coming back down, that gray dotted line, which is a good news for us, but it's still got a long way to come. We're at over 8, almost 9 times. Again, that's like 7 to 8 times average income approximately. So yeah, it's still way too high. Now I do have some other charts to back up my award also for the Prime Minister. Here is one from Global News. I think he pays their salary here, and using CREA and Statistics Canada, same thing that I did. And it takes how many times the average household income to buy an average home. And back in 1980, it was 3 times, went down to about 2.5. And look, you can see there, it's always been, I'll get my head out of the way here. It's always been that, 2.5 to 3.5 times is kind of like the normal if you go back to even the 70s and the 60s and stuff. And it kind of held pretty steady there until 2000, 2005. It started to get up over, like my chart showed very similar data. And now look, 2020, it was up over 7.5 times. It's probably still sitting around 7.5 times or 7 times the average household income. So again, very similar information, not just cherry picking this data to make this Prime Minister look bad. It has been the most unaffordable housing in Canadian history. I don't think anyone would argue that. And if anyone wants to fact check me, please feel free to send me the data. And lastly here, another one. This was from the National Post. Source, Macro Bond and Macro Strategy or whatever. Household Affordability Canada. House prices to disposable income have soared. Of course, disposable would be after tax and whatnot. And this one goes back to 1975. And they're using a different scale here. They're using, a scale starting from 100 in 1975. Look at them. They just went to the moon. Their disposable income went up a lot more than my chart, but regardless, look at the house prices, just through the moon. And that was the latest as of Q2 2021. So again, not hard to believe. Everybody knows that prices, and look how it's not just like they're like a little bit above that long-term average. They're just so far out of whack that it's scary. Like, it's going to take so long to bring this back to where it needs to be, and that's what's going to be bothersome. So it's going to take like a depression, a recession, and a housing crash. Like, everything is going to have to come together, not just some slow downturn. If it was a downturn, it would take like 20 years to bring this back without a housing correction. So I just don't see us not ever having a housing correction. Okay, so that's it for this week. Let me know what you think. Do you think the script has flipped in Canada? Are you hearing a lot more people talking bearish talk about the real estate market and the market in general, I guess all financial markets? Or are you hearing the opposite? Are you hearing people saying everything's going to be great and things have never been better? I doubt you've heard that. But anyway, let me know in the comments, and I'll see you next week.